Hello, my friends. As many of you may know, this channel is all about food, fun, and finance. Food feeds your stomach. What's as important to know is that finance feeds your brain, and that knowledge will help put more money into your back pocket. In today's video, Ling is going to give you an update on how she uses an option strategy to increase her returns to 22%. If you haven't already done so, please hit the subscribe button, click the bell for notifications, hit the like button, add a comment below. We greatly appreciate it. Let's go. Hey Ling, before you dive in, could you please freshen our memories on what the dogs of the Dow is?
The dogs of the Dow strategy is at the end of each year, evaluate each of the 30 Dow Jones stocks and invest whichever 10 stocks that has the best and the highest dividend yield. Based on 2022 data, these 5 stocks are a part of the dogs of the Dow list. As you can see, the first 4 stocks has more than 5% dividend yield, and 3M company has 4.94, which is close to 5%. Assuming you purchase 100 shares of each stocks at the end of 2022 with a total cost basis of $27,350, you will receive a dividend payout at the end of 2023 for a total of $1,564. That equates to an average of 5.71% rate of return, which is also assuming the dividend payout remains the same for 2023. Just a quick side note, the dogs of the Dow strategy actually recommends owning the even dollar amount for each of the stocks and not even share amount. So in this example, I'm actually using 100 shares for each of the stock with a cost basis of $27,350, and this is just for demonstration purposes.
Great info so far. Do you want to dive into the first strategy?
The first option strategy is called cash secure put. Click on the link above. I have made a video specifically for cash secure put. When the market opened on January 2nd, I sold a cash secure put for Verizon stock at a strike price of $40 with expiration date of June 16th. And the premium I received was $424.31. At this point, I don't own Verizon stock yet. I'm only selling the right to any potential Verizon stockholder to sell their stock to me at a strike price of $40 on or before expiration date of June 16th. So I put $4,000 in my account's reserve in case I need to purchase the stock, and in return, I have gotten the option premium of $424.31. If you use the option premium for $24.31 divided by the cost basis of $4,000, that equates to an option rate of return 10.61%. The stock can go up or down. Now let's break it down to take a look at each outcome. For the first scenario, let's say when we approach June 16th and Verizon stocks goes up above the $40 strike price. In this scenario, nobody is going to want to sell their stock to you at $40. So this option would expire worthless. My gain or profit at that time is $424.31, which is a rate of return of 10.61%. I'm planning to look for another opportunity to sell another cash secure put for the second half of the year with the expiration date of end of December. I will make sure to do another video to share the results for the second half of the year so that you can see the entire year's return. For the second scenario, let's assume the Verizon stock goes below the $40 strike price when it approaches June 16th. In that case, I will consider rolling the put further out, which means keeping the strike price exactly the same as 40 and roll the expiration date from June 16th to the end of December. To calculate the gain or profit for this scenario, you would simply add the premium from the first cash secure put, which is $424.31, plus any premium that I will be getting for rolling the put further out, which at this time is unknown. The good news is I'm getting at least 10.61% rate of return. Let's also cover the worst case scenario. If Verizon stock goes way below $40 strike price and you don't have the opportunity to roll the put further out, which means you will be forced to purchase Verizon stock at $40 per share. In that case, you will need to hold on to the stock and make a decision on what you need to do for the second half of the year depending on how the price movement goes. Let's calculate the profit and rate of return for the worst case scenario. You first have the $424.31 gain from selling the option of cash secure put. Since you are forced to purchase the stock in June, you will then start receiving the dividend payout for the rest of the year. There will be 2 dividend payout, one in July and one in October, which equates to approximately $128. So together you would have $424 plus $128 and divided by your cost basis of $4,000, that gives you an average rate of return of approximately 14%. Just quick a call out on the ex-dividend date. For 2023, the only one that's published so far is a January 9th, 2023. The other 3 dates have not been published yet. And based on 2022 dates, which I have in the table, we can assume it's going to happen sometime in the beginning of April, July, and October.
Okay, so to summarize, what I'm hearing is since Verizon is one of the large blue chip stocks, the probability of this stock price going down to 0 is slim. So by selling the cash secured put, even though you're not earning the dividends, the option premium actually gives you higher returns. Plus, you have the opportunity after June 16th to sell another option or buy the stock outright and start collecting July and October dividends.
That's a great summary. Wait until I share the second strategy, which is more exciting. The second option strategy I have done is for Intel stock. I first purchased the stock at $27.50 per share. I then sold a cover call at the same strike price of $27.50 for the expiration date of next year, January 19th, 2024. By selling the cover call, I'm already locking in the 16.52% rate of return. You simply use the option premium of $454.31 divided by my cost basis, which is $2,750. A quick refresher of cover call. So I own Intel stock. When I sell a cover call, I'm essentially selling the right for any potential buyers, the right to purchase Intel stock from me at the strike price, which is $27.50, either on or before the expiration date of January 19th, 2024. Now let's also talk about the 2 possible outcomes. The first outcome when we approach January 2024, if Intel stock goes above the $27.50 strike price. On 19th or before the 19th, I will be forced to sell my Intel stock at $27.50. The profit for this outcome would be the $454 option premium plus the dividends I will be getting for the entire year of 2023, which is approximately $144, with a total gain of $598.31. And if I use $598.31 divided by my cost basis of $2,750, that is a 21.76% rate of return. The second possible outcome, what if the stock price goes below the $27.50 around January 19th? What will happen at that time is my cover call option would expire worthless. I would still own the Intel stocks. The profit as of January 19th, 2024 would be exactly the same as scenario number 1, which is $598.31. At that time, what will happen is, depending upon how Intel stock price movement happens, I will have to make a decision to either hold on to the stock for a little bit longer and find opportunity to sell the stock when it goes back to at least 2750, or sell another cover call during 2024. And the worst case scenario for Intel is going to be if the stock price goes way below the 2750. That would mean I have to hold on to this stock much longer in 2024. However, for 2023, no matter the stock goes above or below 2750, I have a rate of return of 21.76%.
Once again, Ling, thank you for sharing your technical and tribal knowledge on investments. I hope you all enjoyed watching this video. If you found this video helpful, please subscribe to this channel, hit the like button, and share with anyone who may also benefit from this information. See you all very soon. Bye.